Welcome to this explainer. We have a lot of ground to cover today because, honestly, we're synthesizing a truly chaotic week in the markets. We are talking about historic macroeconomic winds literally colliding head-on with severe geopolitical shocks. So, today, we're breaking down a portfolio strategy built specifically for both of these realities, playing a strong offense when the data is great and a tight defense when the world gets complicated.
Here's our roadmap for today's briefing. We'll start with macro relief covering inflation and banks, move into the geopolitical shock of surging oil, and then cover crypto's institutional era. After that, we'll give a report card for Brookfield Renewable, put a spotlight on the leveraged oil trade, and wrap up with the week ahead. Let's dive in.
Part 1. Macro Relief, focusing on inflation and the banks. Let's kick things off with Act 1, which is the incredibly bullish reality we saw early in the week. This was driven by the most deflationary consumer price index print we have seen in 6 whole years. I mean, this number is just historic. June CPI dropped 0.4% month over month. That's the largest single-month decline since way back in April 2020, when the global economy was basically in freefall. And what drove this massive relief? Well, it was a complete collapse in energy prices in June. It really proves that oil prices have been the dominant driver of headline inflation this entire time.
But the real story here is the contrast. While headline CPI landed at an annual rate of 3.5%, which was already well below consensus, core CPI, which strips out the noisy stuff like food and energy, was completely flat for the month. It's sitting at just 2.6% annually. That is incredibly close to the Fed's 2% target. Because of this, the probability of a July rate hike effectively collapsed. It went from a 35% chance down to just 15%.
And get this, on the exact same morning we got that incredible inflation data, the banks reported. JPMorgan posted $21.2 billion in net income for the quarter. $21.2 billion. That is the highest quarterly profit in U.S. banking history. So safe to say the banks are doing just fine. But it wasn't just them, right? All 5 major U.S. banks beat their estimates. The absolute crucial point to take away from this is that despite higher rates and lingering inflation, the underlying U.S. business engine and the U.S. consumer paying their bills is exceptionally healthy.
Adding to all that macro confidence, Federal Reserve Chair Kevin Warsh delivered 2 days of congressional testimony. He made a fierce vow to maintain Fed independence, basically promising lawmakers he is entirely focused on fighting inflation, impartially, based solely on the data. He also pointed out that artificial intelligence investment is currently the single most striking feature of the entire economy. He even noted that what we call AI investment today will soon just be called normal investment.
Moving on to Part 2, geopolitical shock and surging oil.
Now, as you know, markets rarely stay simple for long, so we need to pivot, transitioning from our bullish offense to playing some very serious bearish defense. Think about it. If the domestic data is so incredibly bullish, why on earth did the VIX fear gauge suddenly spike from a calm 15 all the way up to 20 by Friday's close? The answer lies entirely overseas, as a sudden and severe shift in international sentiment grabbed hold of the markets.
Let's track exactly how this escalated across a really tense Friday. By the morning, Iran escalated the Middle East conflict dramatically by striking Kuwaiti power and water desalination plants. This is a massive deal. It's the first direct attack on Gulf Cooperation Council infrastructure since the war began. Then, by Friday afternoon, things got worse. Iran actually asked Houthi forces to close the Red Sea. If the Red Sea and the Strait of Hormuz are threatened at the same time, you're putting 35 to 40% of the entire global oil trade at risk. Unsurprisingly, Brent crude surged 4.6%, closing at $88.10.
Part 3. Crypto's institutional era begins.
Underneath all this extreme geopolitical volatility, some massive structural shifts were quietly taking place in digital assets. We are watching the legacy financial system absorb blockchain technology in real time. Just look at this institutional blitz from the week. Visa is rolling out a stablecoin engine for 200 million merchants. Citadel Securities dropped $400 million into Crypto.com to build 24/7 tokenized markets. The DTC, which is literally the backbone of the U.S. stock market, is piloting on-chain stock and treasury settlements. The U.S. and U.K. announced a joint 10-point roadmap for tokenized finance. And Japan, they are straight up building a national on-chain financial market using SBI and Solana. Through all this geopolitical fear, Ethereum held impressively strong, acting a lot more like an infrastructure asset than some speculative token.
So what does this all mean? The translation is actually pretty simple. Crypto is no longer a speculative experiment.
It's a fundamental transformation of the global payment and settlement infrastructure. Wall Street is migrating the entire back end of traditional finance to blockchain rails, and honestly, they're doing it so smoothly that the everyday consumer won't even notice the switch.
All right, part 4, a report card on Brookfield Renewable.
Let's open up our portfolio playbook and see how these macro forces actually impact specific allocations. We're giving Brookfield Renewable, ticker BEP, a solid grade of B+ for the week. With the stock trading around $34.59, multiple analysts have just raised their price targets to that $40 to $42 range. Why? Well, because those collapsing rate hike expectations make BEP's 4.6% distribution yield look highly attractive. Plus, all that rising Middle East instability makes BEP's contracted, reliable, renewable power absolutely vital for AI data centers, facilities that literally cannot afford power disruptions. All of this sets up their July 31st earnings report as a massive catalyst.
Part 5. We're putting a spotlight on the leveraged oil trade.
So with the Iran conflict escalating, let's talk about how traders are utilizing the UCO leveraged oil ETF. But listen to me, you have to proceed with extreme caution here. UCO seeks double the daily return of crude oil, but this comes with a silent killer, beta slippage, otherwise known as volatility decay. Because it rebalances daily, a volatile sideways market will actively destroy the ETF's value, even if the price of oil just stays flat. Add in the high expense ratios and market contango, which is just a fancy way of saying future oil prices are higher than expected spot prices, causing rolling losses, and UCO becomes a guaranteed value destroyer if you try to hold it long term. It is strictly a tactical tool.
So, if you're going to use it, here are the strict, absolute, non-negotiable execution mechanics. First, you size appropriately, no more than 2 to 5% of your total portfolio. Second, you only enter on confirmed escalation news, like that GCC infrastructure attack we talked about. And third, you absolutely must exit within 2 to 4 weeks or immediately if you hit a strict 15% stop loss. Targeting a 15 to 20% gain if Brent pushes to $95 or $100 requires absolute, emotionless discipline.
How does this all fit together into a broader strategy? Think of it like a puzzle. You keep 15% in a broad energy ETF like XLE. You put 5% in a solid producer like Devon Energy, and then you allocate just a tiny 2% to tactical UCO. The rest of your portfolio, that remains completely diversified. This is how you build a smart, risk-managed energy allocation designed to benefit from a collapsing Middle East ceasefire without betting the entire farm on daily volatility.
Finally, Part 6, the week ahead.
Let's get prepared for the next major market catalysts. Here is exactly how the data drops sequence out. Tuesday brings existing home sales, which will test if those lower rate expectations are finally helping real estate. Wednesday is huge. Nokia's Q2 earnings will grade our entire AI and cloud infrastructure thesis based purely on their order book growth. Thursday brings jobless claims and big tech earnings. And all of this culminates with Friday's durable goods data, which sets the final stage for the July 28th and 29th FOMC meeting, where we're expecting a neutral to dovish hold from the Fed.
Which leaves us with this final crucial thought. A balanced portfolio might be up 21% this year playing both offense and defense, but the game is far from over. June's inflation dropped simply because oil dropped. But with Brent crude now surging right back toward $90, are you prepared for what happens when next month's inflation data collides with a potentially closed Red Sea? That is the exact tension we're going to be tracking. Thank you so much for joining this explainer, and we'll see you next time as we analyze the fallout together.